So without further delay, let me pass the floor to Mr. Theodoros Lizardos. Theodore is a seasoned professional. He's vice chairman and executive board member of 3K Investment Partners, which also supports today's conference. And his session is going to be on trends and looking forward. So Theodore, the floor is yours. Thank you.
Hello, good afternoon to everybody. It's a pleasure to chair this discussion and to support this insightful conference. It's true that asset management undergoes, like many other industries, structural changes. Increased geopolitical and economic fragmentation redefines capital flows and risk assessment. Private markets are playing more and more an important role in asset management. They offer new opportunities, but also they raise questions about valuation and transparency and governance. Also, data science and artificial intelligence is having a huge impact in our industry, the asset management. And we see that gradually AI pushes the industry towards more systematic and data-driven decision making. Also, sustainable investing is maturing. There are a lot of questions about it. And in today's discussion, we will our speakers will answer the questions how tools such as divestment actually lead to real changes in firms' behavior. So we have three distinguished speakers with us: Dr. Maria Vassalou, Dr. Rowe Tasitsiomi, and Professor George Skiadopoulos. They will offer us their insights and perspectives on three themes: how investors' practices are being reset, what sustainable the investment actually achieves in the firm level, and how AI is resetting asset management in practice. After their thoughtful presentation, a Q&A session will follow. So please make sure that you post your questions and comments, and we will address them through our expert speakers. So let me invite Mrs. Dr. Maria Vassalou. She's the head of the Pictet Research Institute at IFFR Fellow. She combines a strong academic background in financial economics with senior experience in global asset management. Today, she will discuss what it really means to reset investor practices and how decision-making frameworks need to evolve in a more complex investment. So, Maria, please, the floor is yours.
Thank you very much, Theodore, and thank you all for inviting me and for the opportunity to speak to you. First of all, I just want to check that you can all hear me well. Unfortunately, I had to connect through my phone because my firm does not support Zoom, so I hope everything goes well. And for that reason, I won't be able to share any slides, but I'm going to simply talk about the topic. This is a topic that we have spent quite a bit of time at the Pictet Research Institute thinking about. And the institute was set up 2 years ago to exactly study long-term trends that affect our business and the way we approach investing. And certainly we are all aware that we live through a pivotal time in our history as the history of mankind and modern world, where the principles under which the world had been functioning until recently are no longer in place. So since the end of the Second World War, and particularly since the end of the Cold War, there had been in place a global arrangement by which, a global financial arrangement, if you like, by which the rest of the world was producing surpluses that will ship them over to the US. And in exchange, they would receive US dollars, US safe assets, and equity returns, because the US would use a lot of the surpluses to invest in technology and innovation. And this arrangement worked so long as the US was the undisputable leader in technology, because the investment and leadership of the US in technology and innovation effectively functioned as collateral or as a guarantee to the supremacy of the US dollar and the safety of its assets, and as a guarantee that it will continue to be able to grow and sustain its financial situation. So in that way, the US had been mitigating the well-known Triffin dilemma, by which as countries become reference currency providers, and as a result, they need to issue more and more debt to fulfill this requirement, their credibility starts getting eroded, and therefore they eventually end up not being able to sustain the exorbitant privilege of the currency provider. And that happened in the past to Britain, to Germany, to other countries. So the US has been the country that has served this role the longest, exactly because of its ability to use those surpluses that it was receiving and anything else to invest in technology and innovation. And so under that arrangement, it made sense for the US to promote globalization and free trade and world peace in the sense of not systemically important wars. But what has changed in recent years is that the leadership of the US as a technological pioneer has been increasingly challenged, and it's been challenged by China. That's well known these days to everyone. But actually, it goes beyond just the AI models that China is producing and so on. What effectively China has done since the late 1970s, since under Deng Xiaoping, is recognize the importance of resources as a strategic a weapon of growth, and accumulated a lot of them very systematically across the world, while at the same time building valuable partnerships and relationships with resource-rich countries and countries that controlled important trade routes and so on. So effectively nowadays, a lot of people talk about moving away from the unipolarity of the US and towards multipolarity. But in fact, what we have is a bipolar world for most practical purposes. On the one hand, the US surrounded by G7, and on the other hand, China with the BRICS. And of course, both coalitions have their issues, but China has been extremely strategic in constructing this coalition of the BRICS, which really functions very much in a similar way as G7. So it has a consultative function rather than being something equivalent to the EU. And includes, apart from the original countries, which were Brazil, Russia, India, China, and South Africa, it also includes Egypt, Ethiopia, Indonesia, Iran, and the United Arab Emirates, while there are a lot of other countries that are affiliated with it. And in fact, what is happening with this coalition is that they consolidate tech capabilities, energy resources, vast deposits of commodities of all types. They control trade routes, military capabilities, and they have together positive demographic and growth prospects. In a world where technology is the defining factor for future growth, the capabilities and strengths they control are really very significant for the ability of any country, including the US, to promote their technological ambitions. And we've seen that also with the recent trade negotiations between the US and China, where the US effectively had to back down from its tariffs threats because of the lack of rare earths that China controlled. So we are effectively in a world where everything we knew has changed. And I can go on for a long time, but we only have 15 minutes, so I will try to keep the discussion short, and potentially we can expand during the Q&A. But effectively, we have all these issues, plus the demographic deterioration that we see in many economies. This is actually a global phenomenon, but it hits first the developed economies and China to some extent. And at the same time, we have transformational technological revolutions through the AI and, of course, robotics, that it's a technology that hasn't yet been fully diffused in the economy. So there are a lot of things happening. But one thing that is certain is that asset management, as we know it and as we practice it, has been established under a set of principles or a set of conditions under which the global markets and global geopolitical order were functioning, and these conditions are no longer in place. So when you build a practice on the basis of certain conditions and assumptions, and these conditions and assumptions drastically change, that also means that at the very least, you need to revisit your asset management practices and see whether they're still relevant. And in the series of reports produced by our institute and available on our website, we're trying to do exactly that. So one of the, and I will mention just a few things. So we are very accustomed in terms of splitting the investment universe into developed markets and emerging markets. We argue in our work that this categorization no longer makes sense. What constitutes an emerging market and traditionally a developed market are no longer in place. So this categorization changes significantly, becomes irrelevant. Countries that are traditionally considered developed markets, developed economies, may no longer be developed or as strong in the future as they were before. The separation of private and public markets will change. The cost of capital will change because you're not going to have the same level of free flow of capital now as we had in the past. But capital flows may become much more regional in nature. So at the same time, the whole process may be much more inflationary. The demographic issues and the technology will also have important implications, because effectively what you're having is an effort for technology through its productivity gains to make up or mitigate the demographic decline. And so and as the populations also change, their preferences change and their consumption patterns change. So what becomes more attractive as an investment going forward will be very different than what it was in the past. So there are new lenses through which to examine investments. For instance, one lens that we consider in our demographics and technology study is whether an investment is conducive to automation and AI. So we show evidence of different industries being more conducive than not, the productivity gains that you can get, the effects you have on GDP growth for different countries, how the different countries stack in terms of those dimensions. Then you have the consideration of whether that particular sector caters to the aging population. And when I mean aging population, I don't necessarily mean just very old people in retirement homes, because a lot of people, when they think about demographics, they think in those terms. But as young people transition to middle age, which is the biggest part of their productive life, they change consumption patterns. And those consumption patterns will affect how, which sectors will be in more demand than others. And what you actually see is that some of the more old economy sectors may become much more appealing going forward than before. And then all countries are not going to progress in those dimensions in the same way. So you also need to think about infrastructure and the conditions in an economy that will enable this productivity gains to happen. So effectively, you have a lot of changes, and you need to think in terms of the investment universe in a completely different way. And perhaps the existing asset classes, as we define them, make no longer sense, and they need to be redrawn. So there are a lot of things, and also the way we measure risk, the way we estimate expected returns, the currency exposure and the currency risk in our portfolios. All these things have changed dramatically. So there is really a need for a complete reset of the way we approach asset management and investing. And I would say that asset management becomes much more thematic going forward around the drivers of growth, which are largely technology, resources, energy, availability, and productivity. So we'll stop here, and I look forward to the other discussions and the Q&A at the end. Thank you.
Thank you, Maria. Such a big topic.
Yeah.
Let's pass the baton to our host, Professor George Skiadopoulos.
Thank you, Theodore. I'm going to share my screen now.
And Professor of Finance at the University of Piraeus and visiting professor at Queen Mary University of London. In his presentation, he will examine whether sustainable divestment leads to tangible changes in firms' behavior, or it just moves the ownership and the risk to others. So, Mr. Skiadopoulos, please share with us your insights.
Thank you, Theodore. Let me just trying to find the file here, but I cannot for some reason. Changed settings. So I will try to keep it short. So please give me a shout if I exceed my allocated time. So this is going to relate to the ESG topic we heard about, and it also relates to the role of investors in affecting firms' environmental profiles that Sarah Williamson talked about. And it also partly relates to AI that Rowe is going to talk about, since we're going to present an example of how AI can help us quantifying climate change risks. So the outline is going to be as follows: the role of sustainable investors, the so-called divesting channel, some recent evidence on the divestment real effects, a new metric that we call climate change price pressure, which is of interest, we believe, to investors and policymakers. How can we compute it in practice? And then a couple of case studies on how we can use this new metric to detect greenwashing by investors. So when we're talking about sustainable investors, we mean investors who do not simply consider financial returns, but also they take the ESG criteria into account when they form their strategies. In this presentation, we're going to focus on the E dimension, the E sustainable investors. And in principle, when it comes to the interaction of these investors with companies for the purposes to make them greener, there are two ways of interacting. One is the so-called engagement. So for instance, by submitting proposals. And the second channel is the so-called divesting, where divesting here means either the underweighting of stocks according to their climate change risks of their firms, or the extreme case where they fully exit from a stock. And even though, at least in the academic literature, there seems to be some consensus that engagement is effective in terms of making firms improve environmentally, there is no consensus on the latter channel, which is divesting. So let's explore a bit more what is going on with the divesting channel and why this may not be efficient as a channel to make firms improve environmentally. So the key idea with divestment is that when an investor divests from the stock of a company, effectively this pushes the cost of equity up, and therefore it imposes a cost on the firm, and in that way it forces the firm to become greener. Now, why divestment may not work in practice, though, is that there are several arguments, actually. One argument is that if the people who care about sustainability sell their stocks, then the buyer is not going to care about sustainability, so there is no way that he or she can make the firm improve environmentally. The second argument is that divestment is not like boycotting a product. When you're selling the stock, somebody else is going to buy it, so the price pressure may not be significant. And from a theoretical perspective, in order for divestment to work, to make firms improve environmentally, certain conditions need to be met. The most important probably is that there needs to be a big fraction of green investors in the economy, which may not be the case. So after all, the idea with divestment boils down to the magnitude of the divestment on the stock price. So in other words, it boils down to the magnitude of the price pressure. So the greater the price pressure, the greater the change in the cost of equity, the greater the cost for firms, and therefore the greater the incentive to reform environmentally. However, we need to always bear in mind that there is a cost-benefit analysis here, so every firm is going to reform only if the benefits from the reform exceed the cost. So the cost in this case is the increase in the cost of the benefits in this case is the fact that if you reform, you're going to cope with a lower cost of equity. The costs of the reform are financial, and also they can be more fundamental in terms of organizational structures. So this basically means that the price pressure must be sufficiently high in order to motivate the firm to improve to reform environmentally. So how can we quantify in practice this price pressure? So the idea we had in a recent study, which was published in the Journal of Financial and Quantitative Analysis, is that when an investor faces a firm-level climate change exposure, then he is going to rebalance the portfolio. This rebalancing is going to induce a price pressure, and we call this the climate change price pressure. So more formally, this CCP can be computed for every single stock, and it computes the percentage change in the price of the stock per change of one standard deviation in the climate change exposure. And the questions we addressed in that study were the following. First, whether the institutional climate change price pressure affects firms' cost of equity. If it does, then does this make the firm to improve environmentally in the future? Is it the physical or the transition exposures that create a CCCP? And which types of institutional investors contribute to any CCCP effects? So I'm going to give you some pictures here to motivate a bit the discussion. Here you see, for instance, the CCCP for 3 stocks, Apple, Pfizer, Procter & Gamble. You see how this CCCP evolves over time. So as I said, in principle, you can compute the CCCP for every single stock. And here we see the average, if you like, CCCP and how this evolves over time. This is in the left figure. And in the right figure, what you can see is how the sensitivity of investors with respect to climate change exposure changes over time. What we can see here is that there is a period where CCP, the average CCP is very strong. It's very negative, meaning that an increase in the climate change exposures decrease the price of the stock. And this coincides with periods where you have a respective portfolio rebalancing activity of the investors. So the key findings from our study, we did this exercise for every stock in the S&P 500 universe. And what we found was that indeed, when this climate change price pressure intensifies, this increases the cost of equity by up to 6% of the average cost of equity. However, this is not sufficient in order to make firms change their future environmental profile. In terms of institutional investors, banks and insurance companies are the ones which rebalance their portfolios the most with respect to regulatory and physical climate change exposures. On the other hand, brokerage firms do not react at all, and this makes sense because brokerage firms do not care about ESG. They're just transmitting orders on behalf of their clients. In terms of quantifying the impact of CCP on the environmental profile of the firm, we proxied the environmental profile of the firm by alternative measures, namely green patents, emissions, and environmental expenditures and fines. So this CCP, we believe, is a new metric of interest to policymakers, investors, and firms because they can identify whether investors walk the talk and which are the firms under pressure by institutional investors. So in principle, one can calculate CCP for every stock at any point in time. So what do you need as a practitioner to compute this CCP? You need the portfolio weights of the involved institutional investors. So in our study, we used the 13F database, which has institutional portfolio holdings for all US investors. Then you need, of course, proxies for firms' climate change exposures. These proxies can contain either hard information like ESG ratings or carbon emissions, or soft information which can be extracted by AI tools, like, for instance, textual analysis. Then what you need also as an input is the sensitivity of each investor's portfolio weights to changes in climate change exposures, each investor's stock ownership, and each investor's demand elasticity. So how much the portfolio weight of the investor changes when there is a change in the price of the stock. And speaking about proxies of climate change exposures, you can have either firm level proxies or aggregate proxies. So what I'm showing here to you is proxies that we have developed using information from Reuters News. So the picture on the top shows how the natural disasters risks evolve over time. And the bottom picture shows how the regulatory climate-related risks evolve over time in US. These measures have attracted attention from investors and policymakers like the European Parliament, OECD, US, SEC, and others. So for this reason, we keep updating them, and you can find them on our websites. The original study, originally we constructed them up to 2020, and since then we keep updating them. If you want to get a feel about the aggregate CCP, so aggregate CCP is the CCP computed from our measures, the aggregate market-wide measures. Here you can see its evolution over time. This is for regulatory CCP, so CCP coming from regulatory climate risks, and on the right panel from physical climate risks. So again, here you can see we can quantify how, say, the big three institutional investors, Vanguard, State Street, and BlackRock, how their sensitivities, how the sensitivities of their portfolio weights look like with respect to climate change exposures, and you see how these sensitivities evolve over time. What it is interesting to note here is that these sensitivities are not always negative, meaning that when climate risks increase, their portfolio weights decrease, but they can also be positive. Here you see the histogram of these sensitivities across all institutional investors in US, how they look like. And again, you see that these climate betas for some investors are positive, for some others are negative, right? So it's not that every single investor, whenever the climate change exposures of a firm increase, they decrease their portfolio weights. Finally, we can use this CCP measure as a detection tool for greenwashing from the perspective of asset managers. So for instance, here we have a global leader in sustainable investing. I'm not going to disclose who this leader is. Most of its portfolio is managed according to ESG criteria. That's what this investor is saying in its brochures. So what we did was we computed the sensitivity of the portfolio weights of this investor with respect to climate change exposures, and we see that most of the time these sensitivities are negative. So our CCP is somewhat in line with the investor sustainable investment narrative. And finally, last slide. Here we take as a case study the Harvard Management Company. Harvard University's endowment is managed by the Harvard Management Company. It is the largest university endowment worldwide, and Harvard has pledged to divest from fossil fuels and reach net zero emissions by 2050. So we were interested in seeing whether Harvard keeps this promise. In other words, whenever the climate exposures increase, Harvard decreases the portfolio weights. And in fact, the negative signs here that we observe verify Harvard's claim. So you see, this CCP tool is a nice way, provides a nice way of confirming or checking at least claims on sustainability by asset managers. So to wrap up, we believe that our findings are useful for investors, firms, and policymakers. We find that sustainable divestment increases firms' cost of equity. However, it does not affect their environmental profile. So the current levels of divestment do not make firms greener, and engagement may be more effective in this respect. And this highlights the importance of climate coalitions, which is concerning given that, as you may know, climate coalitions have weakened over the past couple of years as some major asset managers have withdrawn from these coalitions. So policymakers, firms, and investors could use our CCP metrics to identify firms under pressure and boost their green investments and detect greenwashing by institutional investors. These results have attracted attention so far from the professionals community. Here you see the Robeco Sustainable Investing Prize that has been awarded, and UBS also got interested in that, and you can find also press releases. So if you are interested in these kind of studies, here are the links. So thank you very much for your time.
Thank you, George. Important, the outcome, apart from the index that you have created, it is that the engagement and the stewardship pays off more than just divesting. So let's invite our third speaker, Rowe Tasitsiomi, Head of AI, Investments Data Science and Research at Rowe Price. Rowe leads the integration of artificial intelligence and advanced analytics across the investment process. Today, she will share a practitioner's view on how AI is already changing asset management, where it delivers real value and where human judgment remains essential. So, we're looking forward to hearing from you.
Thank you so much. It's actually quite refreshing to be somewhere where people pronounce my name correctly. So thank you. Okay, so let me do that. Okay.
I used the short version of your name, though.
That's perfect. Okay, so a couple of things I'm going to touch on. First, I think it's always important to have context about things. So I will start by saying why this new AI is not so new and how it has been shaping, to some degree, asset management for decades. Then I'm going to talk about the new thing, which is the reason why we're talking about AI so much. And I will discuss how I see the so-called new alpha equation, i.e., how things are changing in how we are doing things in asset management. And of course, I'll remind us that nothing is, beautiful, no risk, no cost. So I'll remind us what are potential shortcomings to have in mind when we're thinking about AI. So AI has had a long history of being the next big thing, apparently. Even though it was built on top of, mathematical advancements and findings that took millennia probably to develop, as a discipline itself, it became a thing in the mid-50s. A bunch of very senior professors got together at Dartmouth, and they said, shouldn't we have a discipline, right, that discusses how we can make computers behave like humans? And that led to the so-called first summer. This coincided also with DARPA, which is the defense agency here in the US, with lots of money and funding for interesting projects. So lots of enthusiasm, only for them to realize that, these are all ideas. How do we actually implement those things? As you can imagine, there was nothing close to the computers we have today back then. So these high expectations that were not able to be met led to the so-called first winter. Luckily, the development of so-called expert systems brought back the enthusiasm. Expert systems are very narrow in scope and very deterministic, unlike what people usually talk about these days when they talk about AI. These were literally if A, then B systems, but they served really well several corporations. If you had like a client service line, would it be great if instead of a human, you had, if the caller says A, do B. If they say C, do D. So there was a boom because of that. But then again, the limited scope combined with the fact that there was reduced funding led to the reduced adoption and actually research. Starting on the 2000s, though, many things have changed. First, the preponderance of data with the Internet of Things. AI needs data. So that was a first good condition. Then with the gaming industry, we developed GPUs, graphic processing units, which are much more powerful than traditional CPUs that computers are using. And that computational power is also important when you want to use a lot of data for AI. So could it be that we have entered this finally third summer, and how long will that last? Let's see. That will work. Okay. So before I address this question, let's go through a few things regarding what it is that AI has been helping us do and will continue to help us do. When I think of AI, I think of anything between automation all the way to augmentation and differentiation. So the ecosystem is so broad of what at least I qualify as AI that anything that can help us turn a computer into a system that exhibits behavior we usually associate with intelligence in humans, as far as I'm concerned, it is AI. And you can see learning, reasoning, language, entailment, all the good stuff. Now, when it comes to the financial services, there have been different degrees of adoption. Mostly from personal experience, I would say that I saw the sell side typically, an earlier adopter of quantitative approaches. I started my career a long time ago at Goldman, and clearly, these things were already there, or like not generative AI, but more traditional AI. Quantitative prop trading shops. The buy side, with the exception of quantitative hedge funds, has been slower, and discretionary buy side even more so, for very good reasons. And what are the things that we were doing all this time? So okay. So here I have just a very complicated plot. You don't need to do, we're not going to go through all that. This is from a paper we wrote. It just tries to describe traditional and alternative data and methods. So alternative methods would be AI. And it shows how we have been moving. And the couple of things I wanted to emphasize is that unlike more traditional quantitative finance, what we could do, and we will continue being able to do better, is the fact that we can do predictive models and optimizations in the so-called nonlinear regime. Take it as in the difficult situations. The other thing, of course, is that with AI machine learning, we started being able to understand language, so natural language processing. Classical quantitative finance didn't have a way to address any other type of data other than numerical. So that was a very big shift. And last but not least, I hope you can see that. I don't know why this is here, but anyway, last but not least, I found it. It's the concept of unsupervised machine learning, or AI, or whatever models. What does this mean? Traditionally, we need to know what we're looking for, right? I want an answer to a question I have, but how do I even know I'm asking the right question? Wouldn't it be great if a model can take data, look at it, and come up with things and say, hey, Eero, it turns out that when this happens, something else happens. Maybe you want to look at it. So these were very differentiating, but you can tell that they were focused mostly on investment alpha, right? There was a little bit of execution application, like smart order routing, and some automations in certain pieces of the end-to-end investment lifecycle, but that was it. That was it before generative AI. And then generative AI appeared. You may recall this little plot we had here. Indeed, it seems we have entered maybe the endless AI summer. I often find it funny to think that it took 70 years to become an overnight sensation. So most people saw things from the outside. So they thought that they woke up end of 2022 and the world has changed. But frankly, it was a long time coming. So this is just to describe that there have been people as enthusiastic as actually saying that, oh, could it be that we are entering the fourth industrial revolution? I have my R in square brackets simply because I believe that the technology itself, again, it has been an evolution. It took a long time. The revolutionary element is socioeconomical mostly, right? That now everybody can use those things. Whereas before, you needed to know coding, for example, to be able to use AI. So when I'm thinking of generative AI, I usually think of LLMs, at least within the context of asset management. On the left-hand side, you can see a pretty kind of landscape and taxonomy of where generative AI lives. When I think of language, I can think mainly of help with content consumption and content creation. There has been a 13F mentioning earlier, right? So it can be information retrieval, Q&A, summarization, translation of 10Ks, 13Fs, news, earnings call transcripts, you name it, anything that a professional has to read every day to do their job well. And of course, creation as well, right? You can tell it to create something for you. I'm not going to touch on characterization because it's closer to the alpha generation front, and I have my dog barking. Anyway, so I would say, okay, content consumption and creation, clearly, these are language tools. They help us do that. But it goes a little bit further. As I alluded to, I think there is a socio-economical revolution by virtue of the fact that my mom in Greece, she is not even comfortable with computers, but now she can actually use that. So LLMs provide a very language native user interface and experience. And I think that will lead to more adoption of other types of AI. The AI that we used to have to learn specialized skills in order to be able to access. Last but not least, you probably have heard of agentic AIs, the latest buzzword. I have an opinion, and agents have been also around well before generative AI. But I think generative AI can help us create these little engines that can act on our behalf because it can help with planning. I can elaborate on any point. I'm not going to delve into that more. So that's where we live in. And we have, okay, let's look at it in terms of numbers. 16 trillion. Disclaimer, I know there are economists in the audience, so I have to make sure. Is my dog interrupting? Yeah, give me just 1 second. Apologies about that. Okay, I'm back. So, all right. So, economists, these come with hyperlinks. So the source where I got those things from are available. I wouldn't necessarily say that these are the numbers. These are consultants, people that did surveys. So by no means it's a comprehensive study, just some kind of order of magnitude of what claims exist out there. So 16 trillion, the amount projected to add in global economy by 2030. And then we have 37 billion. That was the enterprise Gen AI spend last year, over 3 times more than the year before. 19 billion of these 37 was on user-facing applications, and so on and so forth. Like you can see the level of startup funding, 50%. The fact that the funding was in enormous chunks, like $500 million plus. And if we go to the models now, 2 trillion is the reported number of parameters of the largest LLM to date, which I'm not even sure it's correct because they don't necessarily disclose all the information. But whatever it is, we know there is a model like that, and it's enormous. And roughly 200 million, again, it's probably much more than 200 million, but that's the number I could find, is kind of the overall cost of the most expensive large language model built. So what does this mean from the standpoint of how asset managers look at things? 73%, they say that they think AI is critical. 77, they say we have strategy and roadmap. I don't know about the difference in 4%. So they think it's critical, but they don't have a roadmap. Oh, they do have a roadmap, even though they don't think it's critical. I don't know. 61%, they say it's going to be a high strategic priority. When it comes to the coolest, newest agentic, a very small fraction say that they're using it. A very small fraction say they plan to start using it as well. The projections clearly by consultants for cost reduction is enormous. That said, about 2/3 of asset managers, from at least the study I used, report modest ROI, and 12% report no returns or negative. That aside, they all say that, more or less, we should expect something positive in the future. Now, what is different in that context? Remember when we discussed AI in the previous years, before Gen AI, the emphasis was mostly on intelligence and investment alpha, etc. We discussed that Gen AI enables content consumption and creation. That means cost reduction. So now AI touches all basic three dimensions of any business, including asset management. It touches the growth dimension, the efficiency dimension, and the risk dimension. And here is just, I'm sharing a framework I put together for my company to start aligning use cases with growth drivers and levers. Okay, so all these things are happening. How will things change? People are talking a lot about the so-called convergence of the investment spectrum. So what they're referring to is the fact that we typically have systematic or quantitative, where we rely on statistics, a lot of big universes, coverage, and speed. And then you have the other extreme, where you're only having humans delving into in depth. And naturally, as you can imagine, now you can start doing both. If you are systematic, you could do a little bit more discretionary and vice versa. And this human intuition and machine intelligence thing seems to be blurring the boundaries a bit. I'm not one of the people that believe that they will converge completely. Just a disclaimer. So I don't know where it's going to stop, this convergence, but I think it's fair to expect, when we're thinking about the future, efficiency, scale, hyper customization, and real-time everything. As advertised, I will end with a couple of reminders. Large language models specifically have been designed to be creative by being non-deterministic. So even though we have ways to try to make them deterministic, there's always the risk of them giving us different answers to the same questions. And finance is not an industry that can afford that. We have the hallucination, we have all these sensitivities around data. We even have concerns whether we can actually keep up with the regulatory landscape and comply with it, because it keeps changing. The other problem that I've seen is that people are going around with AI as a hammer looking for a nail. Businesses have business problems, they don't have AI problems. So that can be tricky. And kind of the third bulk of kind of risks is the so-called emergence. In science, emergence refers to the fact that when you have a very complex system, even if you know how the individual pieces of the system behave, when you put it together, it's hard to anticipate what the overall behaviors are going to be. So you may have emergence of behaviors you couldn't anticipate. For example, simulations of agentic AI trading do not always show efficiency in the markets. If anything, they can show collusion, market manipulation, etc. A more philosophical risk that I started thinking about is the so-called AI monoculture. So what's going to happen if we all use the same tools? Will there be markets? Will there be different positions? So that's something I started thinking about. Best practices reminder, AI is neither magic nor a silver bullet. Definitely should be always considered in a cost risk benefit context, same as with every other solution. It will continue evolving. So if you're wondering, oh my God, how are we going to manage risk? My opinion is the educated user is the best risk management approach. There are several situations that I would suggest you don't rely on it. And most importantly, and it relates to the convergence of the investment spectrum, I believe that these tools are to help you do better and faster what you already know, not what you do not. So when I hear people talking about the convergence, I'm worried because I don't want to see an analyst thinking that they can do, I don't know, how complex models just because they can ask Gen AI to do it for them. So all that aside, we live in magnificent times, and AI used properly can be enormous. Expectations are becoming more realistic with time, and that's good news for people like me. So we are maturing a bit, And of course, this is just the beginning. Thank you.
Rowe, let's jump to the questions. We're running out of time. We have less than 5 minutes, so keep it as short as it can be. So there is one question from for Maria. Could you please give us an example how asset management practices for pension funds should change in light of the demographic issues?
First of all, well, the whole way we construct portfolios should change from that perspective, and it depends very much what pensions we refer to. In the US, you have a lot of pensions that are underfunded, so they're under different constraints than some of the European pensions. But the way that I have seen pensions manage the portfolios is through an asset allocation where there's significant amount in fixed income, equities, and obviously there is a separation by asset class. For instance, a separation between private equity and public equity, and a separation geographically. I think going forward, it makes much more sense to look at allocations through themes that really are going to be driving growth rather than on a particular weights we allocate to asset classes based on models that were developed over past decades. It's a very big topic. I don't think I can do justice to it in a minute or two. And it very much depends on the case of the pension plan. But certainly what I have seen so far was already suboptimal in the past, and I think it becomes more antiquated now.
Thanks, Maria. I apologize that we cannot respond to all the questions. Just pick one more to Iro. Would you say, Iro, that there is an AI alpha? Does the AI help to get an alpha compared to traditional models to predict returns and perform trading strategies? In 2 minutes, please.
Yeah, no, I don't need to elaborate. I mean, again, there are certain things that can be done. Non-linearities are being treated much more flexibly by using models that, they fall under the AI. I don't mean LLMs. I mean traditional AI. Machine learning is known for that, right? So cases with non-linearities, of course, you will have a benefit. Cases where, again, non-traditional data, traditional financial quantitative finance cannot do language, right? Whereas now you can take and calculate sentiment, you can calculate uncertainty, you can do topic modeling and start, finding what themes are emerging so that you start positioning yourself. So this is definitely a lot of alpha opportunity.
Thanks. So a warm thanks to our speakers and to all of you. Let's move to the next session.
Thank you, Theodori. Thank you, Maria, and thank you, Iro. Many thanks for your valuable contribution.